Dividend investors, bonjour. This is Mike Leroux, founder of Dividend Stocks and passionate investor. Welcome to this video where we're doing a follow-up on last Wednesday's video where I told you that stock valuation doesn't matter. I got lots of comments and I want to thank you for that. And then the discussion moved over to Twitter and then more ideas came out of it. And then what I got was, Mike, you made your point, but I still think that stocks are undervalued or stocks are overvalued, and I'm just going to wait for the dip for my favorite stocks to be on sale, and if not, I'm not going to make any trades. And then I went to a discussion with one of my followers, and then he was saying, well, you know what, you better off doing your own research, doing your own calculation, and then finally get to a point where you identify an underpriced stock. And I thought, yeah, well, just give me a few examples, right? Because I don't believe in that. And then he came out with a very interesting story about Exxon Mobil. You know, Exxon Mobil, very strong company, vertically integrated. They go really from the well to the pump. Everything is well manufactured over there, and they're making money at every steps, right? So technically, the oil barrel cannot go lower than 20 bucks for so many years, and it will eventually come back up once the OPEC reduces its production and then the economy starts running again. So right now the stock is undervalued, so we should look at it. On the other side, he said, well, I think Disney is overvalued, so you should not buy Disney and you should buy Exxon Mobil. So I thought, you know what, let's get into that, look at Exxon Mobil, Disney, and I'm going to just put another stock that everybody will agree that is overvalued right now, and it's Microsoft. So I went on DSR stock cards, and what I did is I pulled out Exxon Mobil right there. So you can see that we use the dividend discount model to show fair intrinsic value. We use that tool at DSR mostly to compare 2-3 companies in the same sector and look at their value as a dividend growth machine, but not saying that ExxonMobil should worth 60 bucks, right? There's a big differentiation here. But nonetheless, it shows a huge upside potential, but we still rate it as a pro rating of 3, which is an old, and dividend safety score of 2, which you can bet is not incredible. So we pull out ExxonMobil, Disney, which is now trading around 100 bucks. Our DDM value is 130, so this one technically should be still undervalued. So just to show you that depending on who you talk to, it will be undervalued or overvalued and whatever. And finally, Microsoft, which is one of my favorite company for a while. And this one, using the same DDM, we have minus 26. So let's now go to the ExxonMobil stock cards to see what's happening. So we can see incredible dividend yield here, almost 9%, and dividend growth since 1983. So basically you can say, oh, I can trust the dividend aristocrats. It has been going through many recessions without cutting or even just forgetting about increasing its dividend. They have always made their promise right. The problem is, if you go into potential risk, is one of the thing is high yield. You know, at 7-8% yield, you can think that we might run into a problem at one point. The market is expecting maybe a dividend cut or that the stock will not do so well. And basically the problem right now for ExxonMobil is, as long as the oil barrel is so low, new exploration project won't happen because it doesn't make sense. So CapEx investment will be cut down and eventually it will hurt the bottom line, right? The advantage that this company has over many of its peers, is that the company has massively invested since 2017. So it's been 3 years already that they're putting a lot of capital into new projects. Some of them are already in production. So they benefit from increasing cash flow compared to other companies in the same sector. Nonetheless, when you think about it, the company's stock price right now is around 40 bucks. At 40 bucks, you can think, let's imagine in 2 years, the economy has recovered, the production is under control, and the stock is going back up, maybe up to 80 bucks. That would be like the perfect scenario. So 100% increase in the stock price over 2 years. But then think about what's going to happen in the next 10 years. where do you think Exxon Mobil will go? What is our growth vectors? I mean, the economy cannot grow that fast, and there's a lot of other solutions that wants to get rid of oil, all the renewable energy that are still be there. A lot of people have invested lots of money in there, so it's going to be a strong headwinds for ExxonMobil. So I don't think the business is going to die, but I don't think the business is going to thrive over the next 10 years. I think it's going to be a good dividend payer, but that's about it. So now let's go see Walt Disney. Disney yield 171, so you cannot compare it to ExxonMobil in terms of income, but if you look at our investment thesis, you'll find that Disney is the king of content. It has been for decades now that Disney has specialized in one thing and one thing only. It's to acquire content and then derive multiple streams of income from it. They did it with ESPN, with Pixar, with Marvel, with Lucasfilm, which is Star Wars. Now they're doing it again with Fox assets. This business is incredible. They take one character, one idea, and then they create a whole series of potential income streams. While their parks and cruise lines and movie theaters are closed right now, you can expect that Disney is probably missing on 50% of its quarterly earnings right now. However, they have built Disney Plus. And when they launched it last fall in 2019, they said to their investor, well, you know, we expect to reach 50 to 60 million subscribers by 2024, which is in like 4 years and a half. And then suddenly, with this economic lockdown and quarantine, they have already reached the level of 50 million subscribers this quarter. So while the rest of the business is not doing so well, and it's not their fault because their business model works, but I mean, there's not much you can do when you close your business, right? Well, the other segment will be thriving. What's gonna happen in the next 10 years? Well, that's quite obvious to me. The box office will continue to be dominated by Star Wars and superheroes movies. Disney Plus will be a strong number 2, maybe number 3 behind Netflix, but they will be profitable. And then parks, cruise lines, apparels, name it, all the other income streams, they're still going to be there and they're going to be thriving. So when I compare ExxonMobil and Disney, I think that future for the next 2 years, yeah, maybe you can make a bet that maybe the oil market is going to recover, because if the oil market doesn't recover, there's nothing that's going to happen. Or you can put your money on Disney, where they have a bunch of growth vectors for the next decades and will continue to thrive. Now, you may be saying, well, you know, I'm not too sure about that. Park teams, it's going to take a while. They depend on the economy. All right, fair enough. Let's switch to Microsoft. Microsoft has been overvalued since the age of times, right? You're gonna all agree with me. Revenue growth over the past 5 years, 7.7%, double-digit earnings growth, double-digit dividend growth. I love this company. And the thing is, when you think about it, let's go back to, there you go, investment thesis. Microsoft is always overvalued. I remember in 2017, when I received my money from my pension plan, I bought some shares. I bought shares at $75. At that time, investors were saying, and I'm talking not just bloggers or on Twitters, I'm talking about people from Seeking Alpha, from FastGraph, from most analyst industries, they were all saying Microsoft is overvalued at $75. Just wait until it reached 65, $60. Or the most aggressive were saying $55, right? So all right, let's wait $55 while now the stock is trading almost at $180. Unless Microsoft splits its shares, you're never going to be able to buy at $50. That's pretty much what's going to happen. The company is on a subscription-based model right now, so everybody's paying for Office 365, for Windows, and for all the service that they do for corporate America. More than ever now that people are forced to work remotely, all those services for and the team space based on cloud will be thriving. They have Azure, which is number 2 in cloud space, also going very, very well. We're talking about 80-90% revenue increase year after year. This is just incredible. It's a bowl of growth. So where do you think Microsoft was going to be in the next 10 years? It's going to worth a lot more than 180 bucks a share. That is for sure. So when you compare Exxon Mobil, short-term potential upside, long-term potential upsides, pretty mild, right? It's not going to go anywhere. So you're going to get a good dividend, but that's about it. And this is if, and only if, the oil barrel goes back to 40, 50, 60 bucks, right? If it stays around 30 bucks for a while because the recession that we're in right now is worse than expected, well, ExxonMobil won't do anywhere. So your only investment thesis, your only shot right now is based on the price of the stock. So if ExxonMobil right now would be at 80 bucks, you would not even think about it, right? So what's the point of taking a risk on the cheap stocks right now when you can buy amazing companies like Disney or Microsoft that are probably overvalued, but you know what? In 10 years from now, they're going to worth a lot more, and you're going to still tell me, Mike, they're undervalued, I'm just going to wait. Well, you're just going to wait on huge opportunities to build a long-term dividend growth portfolio instead of trying to chase those cheap stocks, those cheap discounts. Let's go for the high quality, and then you can stay safe and forget about your portfolio for a while. I hope that this point is a bit clearer now. I hope that you have enjoyed this video. Don't forget to subscribe to my YouTube channel, making 2-3 videos every week. Today we're Friday. The market is expected to open in green. So we're now at the 4th week in a row after the so-called dead cat bounce. So apparently it's the longest dead cat bounce ever. I'm not saying that the recession is over. I'm not saying that the bear market is over. Far from it. Don't think that I expect a V-shaped recovery. You know what? There's a lot of data that we don't know still, and we don't know how it's going to develop through summer. So as long as we don't even have this full quarter of earnings report to analyze and digest, we don't know what's going to happen. What I expect right now for the upcoming months is a lot of volatility, but I don't expect is to make change in my portfolio. I stay invested, I am confident, and my portfolio is still going to grow, and this is what I know. But I'm not going to wait for the next 3 months to say that. I know it's going to happen for the next decades. So hope that you I hope that you have enjoyed this video. See you next week, and until then, stay invested. Cheers.